Question 1. Information about the coupon rates on the various long-term fixed-rate debt issues of a company can most likely be found in the A. Non-current liabilities section of the balance sheet, B. Management discussion and analysis, C. Notes to the financial statements. Information about the coupon rates on the various long-term fixed-rate debt issues can usually be found in the notes to the financial statements. The MD&A is more likely to discuss interest rate trends and current financing costs, but not specific information on individual debt issues. The answer is C. Question 2. A company is purchasing a customer list that it expects will provide economic benefits for the next 5 years. The company chooses to use an accelerated amortization method. The choice will most likely result in A. The highest amortization expense in the first year, B. The highest amortization expense in the 5th year, C. An equal amortization expense in all 5 years. With accelerated amortization, first year amortization expense should be the highest. Question 3. The following information on a company is available. We have cost of goods, increase in total assets, increase in total liabilities, change in inventory, change in accounts payable, the amount of cash that the company paid to its suppliers is closest to. Question 4. Which of the following is most likely a benefit of the direct method for reporting cash flow from operating activities? Compared with the indirect method, the direct method, the primary benefit of the direct method is that it provides information on the specific sources of operating cash receipts and payments. Therefore, the answer is C. Question 5. On 1st January, a company that prepares its financial statements according to IFRS arranged financing for the construction of a new plant. The company borrowed New Zealand dollars of 5 million at an interest rate of 8%, issued $5 million of preferred shares with a cumulative dividend rate of 6%, and temporarily invested $2 million of the loan proceeds during the first 6 months of the construction and earned 7% on that amount. The amount of financing cost to be capitalized to the cost of the plant in the first year is closest to. The interest costs can be capitalized, but under IFRS, any amounts earned by temporarily investing the funds are deducted from the capitalized amount. The costs related to the preferred shares cannot be capitalized. Question 6. The following information for the current year is available for a company that prepares its financial statements in accordance with US GAAP. the company's operating profit is closest to. Question 7. For a company that prepares its financial statements under international financial reporting standards, for which of the following assets is it most likely that the company could report using the fair value model? A. Houses built by the company for sale to customers. B. A building owned by the company and leased out to tenants. C. A building the company owns and uses to house its administrative activities. Under IFRS, a building owned for the purpose of earning rentals or capital appreciation, in this case, the one owned by the company and leased out to tenants, is an investment property and can be reported under either the cost model or fair value model. Question 8. The method a high-end custom-built motorcycle manufacturer uses to value its inventory results in the matching of the physical flow of the particular items sold and the items remaining in inventory to their actual cost. Which of the following inventory valuation methods is the manufacturer most likely using? A. FIFO. B. Weighted average cost. C. Specific identification. Specific identification is the inventory method that results in the matching of the physical flow of the particular items sold and would be most suitable for high-end custom-built motorcycles that are not ordinarily considered interchangeable. Question 9. An analyst is reviewing the property, plant, and equipment disclosure related to a company's warehouse. The company uses the IFRS revaluation model. The analyst would least likely be able to determine A. the carrying amount under the cost model, B. the original date of acquisition, C. how the fair value was obtained. IFRS does not require disclosure of the original date of acquisition. Question 10. Other comprehensive income is least likely to include gains or losses on A. the sale or disposal of discontinued operations, B. the translation of foreign currency denominated subsidiary financial statements, C. derivative contracts accounted for as hedges. Gains or losses on the disposal of discontinued operations are reported separately near the bottom of the income statement and are included in net income, not other comprehensive income. Therefore, the answer is A.